Doing pretty well. Happy Friday. Can't believe we're in March already, but that's how it is. Time flies. Again, we have the honor of having Adam Barr joining us. Let me bring him on screen. Hi, Adam. How you doing?
Hi, Tide. Good. How are you?
I'm doing great. Thank you. Uh, Welcome back again. Uh, Pleasure to have you. And just as a reference for our audience, just so they know, over the next few months, we're going to be working very closely with RTV advisors to bring a lot of financial education, tax strategies, a lot of uh, topics that are important for business owners that are gonna get more familiarized with you. So you are gonna be a very welcome guest on a very what is it say, like very uh, short period of time in this show, Adam. So it's gonna be a pleasure to work with you and your team because I know that you're gonna be providing a lot of value to our community. So welcome again, Adam. How you doing?
Thank you. I'm doing wonderful. It's always great spending time with you and the audience. I'm excited to be a resource and bring value. And this is a lot of opportunity. The topic of money and business and finance and success is there's so much to cover. So I know I'm honored to be a household guest with the audience and with you, and I'm looking forward to contributing.
Household guest, that's the word I was trying to think about earlier. But I'm excited because I got the schedule from Juan Pablo for what's coming. Really good topic. So I know that our audience are going to be very grateful for the type of content that we're going to be sharing with them over the next weeks, and we're going to start getting them all warm up with today's presentation, Adam. So the stage is yours, and remember, at the end we will have a Q&A for anyone who wants to ask any questions to Adam. We will have the Q&A at the end. So thank you very much to everyone that is watching us live, and make sure that if you're watching this presentation later that you share it, because share is love. Okay. Okay, Adam,
Sharing
the
is
stage is
caring.
yours.
Thank you so much. And thank you again, everyone, for joining us. I'm going to start with a story as I start most of the conversations that I have with individuals and with groups. So I'm going to share with you a story of one of my clients. His full name is confidential, obviously, but we're going to call him Moses. And Moses was a very young, ambitious individual who immigrated to America, and he came to America with about $600 in his pocket, right? Many I know. How many of you came to America with a little bit of money in your pocket and you made it a very successful life and business and family? And so I know some of you are, it's this story is familiar to you. And so Moses came to America with very little bit of money, and he worked for a small business owner, kind of who took him under his wing and started learning the real estate business. And he got into some of the transactional real estate business, got a little money, earned a little bit more, and then started with his own real estate structure. It was a little apartment in the beginning, and that apartment was sold for a lot more than he bought it for originally. And then he flipped that into a house, and that house became a few houses, and those houses became a building, and those buildings became a few buildings. And through his 20s and 30s, he became multimillionaire. And then something happened, that he didn't expect. He was actually sued. He got into a lawsuit with some of the investors, and a familiar story to how many individuals that are successful. It seems that so many of the successful people get involved in, unfortunately, or get sued because some individuals believe that they have deep pockets, right? But he was able to manage to skate out of that spend over a number of years. So now he's in his mid 30s, almost 40s, and he started having a family, and that took a long time and a lot of effort, right? It doesn't matter how much money you make, you want to be there for your family. If after all, we do it all for our family and our loved ones, right? And he really climbed back from this lawsuit, and again, continued to be very successful. And then 2008 happened, and here he is in his, like much later in the continent. And 2008, because of the way that he was buying those properties in a syndicated fashion, he leveraged a lot of that money. And like many real estate professionals and individuals and structures, his business really, really suffered to a point where he had difficulties even paying basic bills. One of the things that you make when you make a lot of money, you also have a lot of liabilities and a lot of responsibilities. And so when I met him, this is the situation where he was in. And so we started working on some of those structures and tax opportunities and a whole bunch of, like entity structures. And we were able to create a plan that from 2008 and beyond until now, we were able to diversify a lot of the things that he had left even after the debacle of 2008. And we built a more diversified fashion with more conservative stuff, more medium or moderate investments, including the real estate that he was doing, but a lot more risk managed where he didn't have as high of a leverage. So why am I sharing this with you? So I'm sharing this with you for a couple of reasons. But before I tell you that, let me go through this quick disclaimer. Obviously, everything we share is not a legal, tax, or financial advice. If you have any matters that pertains to your particular situation, you got to speak to your CPA, your advisor, and your legal professional. But this is for informational only. So um, the reason why I'm sharing this story with you and the moral of it is that irrespective of how someone wants to be successful and how someone is motivated and ambitious and creative and have money, life and the financial journey, the money journey has a lot of elements to it that we cannot control, right? There's a lot of things in our financial journey, aside of our mindset, that we cannot control. It's ever changing, right? Our life will change. Sometimes it's a lawsuit, sometimes it's starting a family, sometimes is maybe our industry is really changing. Sometimes we made the wrong decision. Sometimes it's divorce, right? Sometimes it's business divorce. Sometimes it's competition. There's so many things that are unknown in our financial journey that if we don't have a proper structure for it, it's really going to be jeopardized because we're not prepared for it properly. Okay, the uncertainty in life. I mean, think about what's happening right now with Russia and Ukraine. I mean, it's not crazy, right? Imagine people one day in Ukraine or in Russia, right, having their life just going like everybody else's life, and all of a sudden the business gets affected like that. I mean, how much control do we have over that? But when we look at the financial industry, some of those things, those elements that we cannot control, and some of the things that we can control, for example, we can choose many different financial tools out there. But when you sit and think about, okay, what should I invest in next, or what financial opportunities do I have? Where could I make the most money? There's so many choices out there, an overwhelming amount of information and data and businesses that people a lot of times are overwhelmed. They really don't know what to choose in order to create the most success in their lives. And then we talked about unexpected events and all of the other uncontrollable things. And so the reason why I wrote my book is the intention of it is to create almost like a Maslow's hierarchy of needs for money, where we can provide, um, you know, the insights and the holistic, the comprehensive way of planning and choosing investments, making business decisions, choosing your team members that will help you create this infrastructure and the financial success that you want to create, not just by working in your business, but working on your business and having the ecosystem of professionals to really support you in creating what you want, and really being mindful of all of the unexpected events that are going to likely meet you along the way as you build your financial empire. And so, and even when we have all of those things, there are still threats. And what I see the difference between successful individuals and super entrepreneurs that create mega companies that worth tens or sometimes hundreds of millions of dollars. And they all started in a small business or what we call mom and pop, and then created extraordinary wealth because they had certain things that mitigated those risks and the threats that we're mentioning here. One of the biggest thing, believe it or not, is that having what I call a no plan. So just going about business and trying to make it extremely valuable by sheer drive and motivation, that can get you really far. But what we see, the people that have a written plan and have people on the board and get feedback from the board and have mentors and have a team of other successful individuals that kind of contribute to the plan, we see that as what we call a smart money strategies for business owners and entrepreneurs. And then the other threat that we see is the focus on accumulation versus distribution. So, think about it like you. I mean, many of you or most of you are business owners and entrepreneurs. But how often do we see that business owners really focus on growing the business, growing the business, growing the business? And we never really look at, like, okay, what is my business valued at? Is there any ways that I can enhance the value? What if I have a buyer that is ready to buy my business and can give me multiples of revenues that I can't even imagine right now? Have I checked the valuation? Did I create any other structures that diversifies the risks of the business, right? And then what's my exit or succession strategy? What can I do to increase and grow and accelerate the value in a shorter amount of time in an optimized fashion? One of the other issues that we see a lot is not computing taxes and inflation. I mean, many of you now are living through inflation. Some would say it's 7+%. Some would say, depends how you measure it, it's about 15%. So if you have any money that's sitting in a business, or if you have any value in the business that is not appreciating or growing, at least with the inflation, right? So, and not only looking at that value now, but looking at it when you want to unlock the value in the future, then maybe it's not the most efficient way of building a business, right? And unaccounted risks and liabilities and exposures, lawsuits is a big thing. Miscalculating, right? Not having contribution from other professionals and other business entrepreneurs. And then lack of updates. So we see a lot of business plans and a lot of operating agreements that a lot of time has not been updated, and that could pose a tremendous risk in a business. Sometimes we see individuals that were married maybe at some point of their business process, and then they were not anymore after a while, and then they haven't updated any of the operating agreements or any of their trusts or wills, right? And that could be a problem in the future. And then really looking at things just with one advisor that maybe not providing the full spectrum of consulting and business services that you can have access to. And so we have this saying that we talk about a lot, is when we aim at nothing, we achieve it with incredible accuracy. So if we don't have a written plan and we don't have a time frame and a destination, then I would argue that maybe it's not given us the best possible outcome. And so, in order to create this uniform and organized fashion and to give individuals and business owners structures, I broke it down in my book, Unleash Your Financial Powerhouse, into 4 stages. Because if you think about the story of Moses, what I was talking about earlier, imagine that in his 20s, where he was building his wealth, where he was structuring with the foundation, he actually set up an infrastructure that no matter what happened, whether he got a lawsuit or he got any other obstacle along the way, that he was protected. Imagine if he had a plan for 2008 where he had a growth capital or an opportunity fund that he was able to capitalize on that contraction of the real estate market. And now he had extra liquid money, liquid cash, that he could buy things in a massive discount in a wholesale price, if you will, right? So a lot of people don't think an opportunity fund. So we call this the build stage, building wealth, growing wealth, enjoying wealth is the distribution, right? When you want to get a passive income for the rest of your life, that's or unlock the value of your business. And then we call the last stage is the sharing and the legacy. And every one of you and every one of the people that we work with, you are in a specific stage of your life. And every one of those stages, it has a different objective and different outcome. And I put here on the right, if you see, for example, the building is really creating a strong foundation. Think about it like building a house, right? You have to prepare the foundation and make sure that you have the support and the beams and all of those pieces to have what we call a defensive mechanism or defensive planning. And the growth phase or the wealth building phase is more of an offensive planning, which has growth and appreciation and business building and infrastructure expansion, all of those things, the scaling. But it comes a time where the planning transitions into a different types of planning, which is now unlocking the value of those assets that you built. Think about it, most people think about it like as retirement, but we like to think about it as working because you want to, being involved in your business because you want to, at the level that you want to, not because you have to, not because you have to generate money to support your family and your lifestyle, right? Imagine how valuable that would have been for someone like Moses, and imagine how valuable would it be for you to have an infrastructure like that. That irrespective of the success of your business, you will have a lifetime income and revenue generating structures for the rest of your life. And most people think, okay, well, maybe I'll run my business, I'll sell it for a million, a few millions, or tens of millions, right? Doesn't matter what it is. And then I'll have enough money for the rest of my life. But what happens with taxes? We're going to lose 30-40% of that. What happens if the market change and the business cycle change or the business environment changes and now you cannot sell your business in the way that you wanted to? What happens if you have, for example, other people involved in the business, someone gets hurt or disabled or God forbid die, and now the business suffers, or the key people of the business now don't allow you to run it in the way that it could efficiently run, right? And so all of those stages are very important. And then of course, many of us and many of the successful people, the smart money that we work with, want to create a legacy and an impact that not only that they leave, but also something that lives beyond what they were able to create in this life. And whether they transfer it to their family, or they create a legacy for the community, or they create a nonprofit or foundation, and depending on what level you want to create those things. So legacy is very important to some of our clients. And so I took just a few points to show you some differentiation of what individual and business owners and entrepreneurs do traditionally, what's common knowledge, and then what smart money is doing to accelerate and optimize and create more efficiency in their wealth building, growing, enjoying, and sharing it. So just look at in a building phase, for example, most individuals and business owners and entrepreneurs have a checking account or a savings account. I mean, how many of you have used those structures, right? Many of us do. But what we see the smart money is doing, in addition to a checking or savings account or CDs, right? They create a protection plan. They create a strategic plan with metrics and time frames, and they create a structure for emergency fund, opportunity fund, which is money that is allocated specifically to taking advantage of opportunities of downside markets, recession, depression, contractions of the market or of the business, and then creating a plan for the growth and making sure that they have a full asset protection, that the business um, entity and the business structures has tall enough walls that no predators or creditors can come in and pierce the corporate veil and hurt the structures that they're trying to build, right? So that's really, really important in this building phase. Also, utilization of debt or using credit or raising money. There's different ways that traditional or passive money is using those structures, and then how smart money is using the structures. Smart money often use leverage, and they use what's called positive arbitrage. So, for example, if they could get money for 2% or 3%, and they can make that money work for them and make 6, 7, 8, 10. They can grow a business and expand, and their return on investments is maybe 20 or 30%. So to them, it's a calculation of how can I use this money more effectively, right? Of course, being mindful of the leverage is very important. Not be overstretched or stretch too thin, right? Because that's where contraction can be a problem. But having that calculation would be very important. In the growth phase, traditionally people use stocks or bonds or mutual funds or real estate that people own in their name. And where the smart money, typically what they do, they use tax advantage structures. If they use stocks or bonds, they use a lot of times lines of credits against it, or they use again, arbitrage, what I was talking about, to make that capital work for them. But also, they use the real estate in structures like multi-member LLCs or in syndication, so they create again efficiency there, or tax neutrality sometimes, to benefit more and grow those wealth that they're building faster, right? And then, traditionally, most people want to buy a home, which is great. It's good to buy a home. It's another form of investment. And most other people create, maybe another additional unit in the home, or they create Airbnb opportunities, or they create other structures so they can write off a lot of things, depreciate a lot of things. There's improvements that they can do through what's called cost segregations that can be very valuable. They use a bunch of structures like that to benefit their wealth building, and then position themselves to unlock the value in the future, or create immediate passive income for themselves and for the future, right, and for the family. So the enjoyment phase, or the retirement phase, or the passive income phase, individually people use 401ks or solo Ks or IRAs or SEP IRAs. Sometimes they use their business to create passive income. But smart money use, in addition to those structures, they use things like private pension or defined benefit, which allows them to deduct, create an expense in a business for hundreds of thousands of dollars and over time millions of dollars, and get all that money and all the benefit to them and their employees and the key people that are in the company, instead of just doing like a small percentage for themselves through a retirement account. And they create extraordinary amount of wealth through those types of private structures or defined benefit or cash balance plans. And sometimes they create structures like ESOPs, which allows them to create income tax neutrality. When they sell the business, they don't have to pay capital gains or minimize it tremendously. And then they can still create what's called a synthetic equity, where they still get money out of the business, even though they created the whole value and sold it for the full price. They still get synthetic equity and control, and get money and revenue, even though they transition out of the business, right? Really phenomenal structures that we see smart money doing, and we do that for them as well. Another passive income strategy is right, obviously Social Security, retirement plans, and then there are structures that you can create a lot of tax-free or tax-advantaged income planning with structures that we put together. And then, from a protection standpoint on leaving a legacy for family and loved ones in the community, traditionally people do will, or maybe selling the business or transferring the business to their family, where smart money are using unique structures. Sometimes it's through charitable organizations. They obviously create a trust. And a quick word about a trust versus a will, depending on where you live, but most states, if you don't have a trust, a lot of the assets that you don't have a beneficiary, even a home and things like that, when the parents pass, it goes first to the probate court. Most people don't realize that. They think it's just going to go to the kids, but most of the time it doesn't go to the kids. It goes to probate court, because that's kind of like a holding place that is determining whether the parents owed any money to anybody, or they had any liabilities or any claims or any taxes that was owed. And this process, especially in like states like California, or states that sometimes it takes longer than it should be, but usually it takes about a year and a half to 2 years to get the assets out of the probate court and back to the family. And it also is very costly process. It's sometimes it's tens of thousands of dollars, sometimes it's hundreds of thousands of dollars, sometimes depends on the size of the estate, sometimes it's millions of dollars. And so, how many of you are familiar with, the estate of Michael Jackson or Bob Marley, for example? They didn't have an estate plan, and they're still dealing with their stuff. Prince, also Aretha Franklin. A lot of individuals did not have proper plan, and they found themselves in hairy situations, sometimes decades that is not resolved because people are fighting. Whenever there's money involved, you see families fall apart just because there wasn't a clear document that discusses what that's going to be for the family and for the loved ones, right? So I just wanted to make sure. And a trust not only includes that, protection for the family and for the individuals, it also includes a power of attorney. It also includes things, meaning that if you cannot make decisions for yourself or for the family, someone else that you designate, um, and you can control, you can change it anytime while you still have, while you're still alive. You can designate who's going to be the ones that you trust that will, fulfill on your wishes, right? And then, there's a lot of exchange strategies. For example, when people sell real estate, sometimes they use a 1031 exchange, but there's other exchange structures that we can transfer wealth to the next generation with tax efficiency, which is again keeping more money in your pocket and your family's pocket, as opposed to other people or the IRS, just by default. Well, I'll talk a little bit about taxes in a few slides, but it's not only about what we make; it's about what we get to keep the count. And we talked earlier about control. And a lot of what the smart money realize is that although we cannot control the market, we cannot control business cycles, we cannot control global events, we cannot control the national economy, there are things that we can control. And I call them the ABCDs of investment. And so the A is we can control the allocation. We can control how much money we're putting in our business, how much money we put in real estate, how much money we put in stocks, how much money we put in crypto, how much money we put in mutual funds, how much money we invest in oil and gas or international, right? We can control all of that. We can allocate a certain amount of money based on our risk tolerance. And you can see here, we put the conservative, moderate, moderately aggressive and aggressive based on timeline and horizons that someone would have. It doesn't necessarily means that how close you are to retirement, but it means like how much time do you have to withstand fluctuation. If you take the last 100 years of investment, if you were properly allocated, whether it's in small cap, mid cap, or large cap, right, blue chips, there is a history and data that tells us what it looks like. So even though you cannot project what the future is going to look like and nobody knows, but you know that that's the data that we have for over 100 years, right? And so data, a lot of times is could be another valuable contributing factor in how we could be prepared for the future. Behavior is very important in investments because Taide and I talked about it a couple of meetings ago. People, when they hear money and investments, that they have kind of like a relationship that they have with them, and there's a lot of fear. There's a lot of judgment that comes with dealing with money and working with money and hearing about money and getting involved with money and finance and investments. And so what hurts people is oftentimes the emotional behavior that they have with money. And it's designed by default to kind of like be not the most effective way of making the most money. If you look at what happens in market fluctuation, when it goes up, everybody is going up. But usually what happens is the smart money, they get in very, very early before the actual hurrah, hurrah, that everybody's jumping on the wagon happen. And they leave before everybody else leave. When do everybody else leave is usually when there's a lot of fear in the market. But at that point, it could be, too late because that ship is already sailed and it's either going down or going up. And now we get caught up in this downturn or upturn. So, and this is why, for example, Warren Buffett talks about that you got to be fearful when everybody is greedy, and you got to be greedy when everybody is fearful. It's the complete opposite of what we are emotionally conditioned to do with money. That's why behavior is something that arguably we can control, but we want to condition our clients and the people that we work with to be more disciplined and be more data driven and science driven as opposed to emotion driven, because that is very misleading oftentimes. The other thing that we can control is the assessment of cost and fees. How much are things costing us? What is this investment is costing us? What is this business venture costing us? Not only now to get in, but what is it going to cost us throughout? What is it going to cost us to get out of it at some point? Right? Does it have any stipulation that I have penalties or early withdrawal things that I have to deal with? Right? So some of those things are really important to consider, and that saves people a lot of money. And then obviously the diversification. And when I say diversification, a lot of people think about, yeah, I understand stocks, bonds, mutual funds, real estate, business. That's not the only diversification I'm talking about. I'm talking about institution diversification as well. Where do you put your money? I'm also, referring to tax diversification. I'm also referring to your advisory diversification as well, having feedback from a few different resources and sources, right? That's why we're a valuable resource to our clients, because we have this hub for one-stop shop for individuals and business owners and entrepreneurs to ask people from all of the different professions, from legal, from tax, from consulting, from lending, from all of the, from fundraising, for systems and marketing and scaling a business and investment banking, all of those things that involve different professionals. But oftentimes we bring more than two or three opinions to the table, and then you get to make informed decisions for yourself and your business and your family. And so I talked a little bit about the diversification of taxes. And on the surface, taxes is this one giant, you know, bucket of things that we oftentimes don't like to deal with. We kind of outsource this to our CPA or our accountant or a tax professional. What we find is when we get a basic understanding of the opportunities with taxes, we are much better off because we pay a tremendous amount of money in taxes. And I'm going to show you in a moment how much money is being lost to taxes. That if you just were able to retain some of it, and we help our clients retain the majority of it sometimes, the compound impact of this will create extraordinary wealth for you and your family and your business. And so there's different types of tax treatment. Everything that we deal with financially or business wise or economic goes through this filtering of taxes. So if you think about what you earn, right? How many here making income or revenue or K1 distributions or have passive income through real estate, right? Every one of those dollars that we earn has what's called income taxes. And then we deal with, even after we paid taxes on that money, when we buy an asset or an investment or a business, and that business generate money or income or revenue, we get taxed on it again when we sell it. Okay. And so that's something that we have to think about. It's money that we already pay taxes on, and now that grew or appreciated. Now we pay taxes again. And then there is other elements of taxation when you own wealth. So even if you, or businesses or wealth or assets, whatever that might be, there's things like, and I'll show you in a moment, like net investment and income taxes. There is SUDA and FUDA, federal unemployment or state unemployment tax that you when you own a business you have to deal with, right? So we have this saying that it's not about what you earn or own, it's what you get to keep the count, right? Even if you made 50% return, but if you were taxed on this 50, 60%, and then later on that growth more and more and more, then only what you keep, it counts, right? And sometimes, right, not every year you're gonna have profits, some years you're gonna have losses. And so when you average it out over time, oftentimes we see people that might as well, they could have put their money in the most conservative things, and they would have beat all of this risk and fluctuating types of investments without having headaches or worries and fears and concerns, right? And so our model of tax efficiency, it can become very valuable because oftentimes we find that people choose to reduce risk or diversify it better because we can create tax efficiency. And so here's a little bit of the scope of taxes. Why? And a lot of the clients that I talk to, especially in the business arena, um, we really dig deep into the opportunities of savings with taxes. And then not only savings with taxes, but also getting money by having tax incentives, getting, like, if some of you might do research and development. Sometimes some of you might be able to get the employee retention credits. There's a bunch of stuff. So if you work in import and export, there's a bunch of credits there that you can be incentivized and actually get money for some of the things that you're doing, right? So this is stuff that we bring to the table. But I want to show you kind of like the brackets, if you will, and why it's so important to talk about taxes. And I call it the wealth game because it's almost like a game. The more you know how much you can keep in your pocket, the more valuable this will be for you. Okay, so we talked about income taxes. So every dollar that you make today, I want you, if you think about that journey of that dollar, right? If you get taxed at, let's say, 30 or 40%, and then you live in a state like California or New York or any other states that have any state income tax, now you're going to pay close to another 10%. This is like already 40, sometimes 50 plus percent of every dollar that you make that is being lost. It's a big deal. Okay, and then when you buy an asset, so you manage to keep some of that money, and you bought an asset or investment, or you invested in your business, right? Any new gains or any new appreciations when you sell it, that's new tax that you have to pay. And it's either short-term capital gain or long-term capital gain, depending on how long you held it. And that's another 20 to sometimes 30 something percent of that dollars. And what happens with inflation in the meantime? How many of you needs to buy merchandise, needs to buy things, have just maintenance stuff or service stuff in your business, and now how we see all those costs are going up. That's a calculation of tax that we don't really consider. But I don't, let's not fool ourselves. That's another form of tax that the government has to control cost and to control the money in circulation, right? And so the value of our dollar goes down, and therefore, our dollar doesn't go as far. So this is a recapture, if you will, and another form of taxation. And then we have wealth tax. Even when we build our wealth and our empire, now we get in a whole bunch of other taxes that you hear every administration talks about. We're only going to tax the wealthy, and we're only going to tax people that make over $400,000. And it doesn't matter what side of the aisle you are, but you can create plans for yourself and your family that is also paying your fair share, but also benefiting yourself and your loved ones, and balancing those acts, and really creating a structure that is valuable for you. And then you have a bunch of ancillary taxations that we're not going to spend too much time on, but we calculated that for every dollar that we make, we usually get to retain, again, if you follow that journey of that dollar, maybe 30% of every dollar. And with tax planning, very different than tax filing and what the CPA or the accountant do. Tax planning is proactive planning for the future and for following that dollar and how it's going to be taxed in the future, like estate taxes, local taxes, and wealth taxes, right? So having that tax planning could keep a lot more money in your pocket. So here is a real illustration of why tax planning is going to be very valuable for us. What we know is that tax is treated in three different ways. You can even have a choice that your gains or your income that is coming out of your assets will be taxed now, and then whatever you're taxed in the future is going to be at that point in the future, or not, right? You can choose that it's going to be tax free. You can see the bucket of tax never, and you can have a deferral mechanism that is what's called tax later. Okay, so tax deferral. So some of us are familiar with retirement accounts like 401ks and SEP IRAs and IRAs, right? Those things oftentimes have two of the tax treatment, and the structures that people use for retirement have a choice of either the top two or the second two tax treatments. For example, in a retirement account, like for example in a 401k, you get a deduction today. You don't get taxed for it, but you will tax later in the future, both on the contribution on the gains as well, right? So if you accumulated a lot of money in your 401k, now you can potentially be in a higher tax bracket because you don't have any more deductions like you had in your business. And now, or you maybe not married anymore, or maybe you lost a family member, you lost the dependents, right? You could be in a higher tax bracket. So you can essentially choose which two tax treatments you want. Do you want a tax deduction and tax deferral, but be taxed in the future? Or you give away the tax deduction and you take the tax deferral, and then you don't pay taxes in the future. So the IRS actually allows you to choose which two you want to take. Sometimes what we do for our clients, we minimize, if they have a tax deduction, for example, we minimize the future tax liabilities, and we create discounting, and we give them the deferral so they can kind of effectively benefit from all three benefits of the tax treatment. And sometimes we get a lot of depreciation depending on what, if we use real estate or not, that offset a lot of the future taxes as well. Okay, so it's really important which tax bucket you choose. And here is why it's important. If you're going to create any asset or business that in the future passively going to give you money, right? So if you take the kind of the passive way of doing it, you get $100,000 of income, and let's say your $100,000 is only taxed at a 28% tax bracket. We're not even mentioning the state tax right now. That's, bear with me. So you're gonna get in your pocket net $72,000, right? So far, so good. Good. And so think about what happens if you diversify. That's what smart money do. And they create two types of structures. One in the top two buckets of taxation, and some money, half of that money goes into the other two buckets of tax deferral and tax never. And here's what happened. Here's a real case of what happened. They get same $100,000, but $50,000 they get from a 15% fully taxable, right? Because it's less money that they're receiving, they're gonna retain $42,000 because again they're in a lower tax bracket. And then in the tax never bucket that they get their money in, tax deferred bucket, they get the full $50,000, and to the total of 92.5. Now, if this was you and you had those two options and you look at 72,000 and 92.5, which one would you choose? I mean, this is $20,000 more. It's a no-brainer, right? And the reality is that you cannot switch the tax treatment when it's already come the point where you're unlocking the value of your business, or when you get an income out of your assets and investments. You have to do pre-planning in order to make sure that that happens. Now, we have a lot of tools to do this, whether it's through Roth conversions on and tax offset or loss harvesting, lots of different structures like that that today we don't have time to go through. But I want to give you kind of the big picture of what your possibilities are. Okay, so how do we do that? Every business owners and entrepreneurs that we deal with, we don't assume that their situation is like everybody else, right? We have a process, it's called a discovery process. And it's really a get to know process where they get to ask us questions, we get to ask them questions, truly understand what it is that they're doing right now, what is it that they're trying to accomplish, what things they put in place already. And then it allows us to decipher what valuable opportunities and resources and connections we can bring to the table for them. And again, the strategies that we share, we don't charge any money for it. It's all complimentary. And that's part of the benefit of being connected to Taide and the team, because we bring this to the table at no cost to you. We do a coordination with our professionals. There are needs, and the recommendation would come next after the discovery. In the recommendation, we would share the ideas and strategies. For you, again, it's no obligation. You can make a decision for you, an informed and educated decision of what could be valuable, right? Whether it's fundraising, whether you want more capital, whether you need to have scalability structures in your business, expansion opportunities, right? And different types of investments, different types of real estate structures with our referral partners and strategic partners. I mean, then we help you. We literally would hold your hand and help you coordinate it. We have what's called a team-based approach. that we want everybody that is involved in your success, in your business success, whether it's your accountant or if you don't have a tax professional, we can help you bring, competent, advanced knowledge, professional experts in that field that can really help you optimize what you do, whether it's your legal professionals or just consultants, right? We will coordinate a meeting with you and us and them to really make sure that everybody's on the same page, making sure that your vision is being implemented in the way that you want it to be done without really having any of those, what we talked about, the unexpected risks or exposures or liabilities along the way, right? And then we do the implementation phase, and again, it's a relationship that we implement things over time with you. And oftentimes, whether we're in a building phase or growing phase or income phase or legacy phase, there's going to be different needs and different implementation, because your situation is dynamic and we want to be there as part of your team to help you create the most optimal model that you want for yourself. And so here's how to get a hold of us. We're a phone call away. This is my direct number, my cell phone number. We're in different. We have different offices, both in California, we're in Dallas, in Atlanta, and in Hawaii, and we're expanding around the nation. And so we have both English speaking, Spanish speaking, and multiple languages on our team members that they speak. I speak a number of languages myself. And you can email me if you have any questions. And I'd like to see if there's any questions now. So we'll open the floor.
Thank you so much, Adam. This was a great presentation. Let's switch to, there we are. Um, Man, every time that you come to the show, you drop golden nuggets of knowledge. Um, First off, I really like when you started, with your story, but I also like when you mention about the ecosystem of professionals. And this concept, as simple as may sound, when you are a small business owner, it has a lot of meaning because having experts that are going to help you in different areas within your business is priceless, especially for a fraction of the cost, right? Because you can have an attorney on a full-time payroll. You cannot have, a tax strategist on a full-time payroll. So working with RTV and your selected group of advisors, because to my knowledge, you guys have a very uh, through a very deep process on how you select the people that you work with. It's not just like,
Absolutely.
oh, Taide Aburto is gonna be like the financial advisor, so that gives potential clients the trust of knowing that you guys have put together a group of professionals that are gonna deliver and that they're gonna try to provide the best service that they can based on your specific profile, because this is extremely important to address. Each one of us has different situations in terms of our
Right.
finances and the money that is coming in and the businesses that we're managing and stuff. And I don't know if you want to elaborate a little more on this, Adam, because
Yes,
well,
absolutely. I mean, you touched on a couple of things that I think very, very important. One is cost, right? There's a misconception sometimes that in order to work with some of the best in the industry, you have to come up with a lot of money. And sometimes we not only that it doesn't cost money, we find money for them through incentives, through tax deductions, through different structures that allows them, even if there was a cost of anything, right? That it would allow them to really have, state of the art professionals and experts right in their corner and right there helping them and protecting them and making sure that they are doing the right things for themselves and their business. And then the second thing is, we take an extraordinary amount of time to vet professionals and experts. Anybody that we're willing and open to collaborate with, they have to have oftentimes decades of experience, and we want them to be advanced knowledge. We want them to be super knowledgeable and have been working in their areas of expertise for a long time. For example, the legal group that we work with, and I think they're going to be speaking to the audience as well in a short time. We're going to create a curriculum. They've been in the business for decades and decades and decades. People come to them from all over the country. They have, thousands and thousands of clients, business owner clients, and so they've seen, real practical situations, and they have advised the, business owners and entrepreneurs on what would be the best, outcome and results, and what are the steps for them to get there, right? And so we take, a tremendous pride in vetting individuals and firms that we work with and bringing it to the table, because something like that for a wealthy individual, something like that, would be like a family office structure that people will go in, that typically have to have tens of millions of dollars. What we wanted to create is something like that for the middle market, and
Mm-hmm.
people like you and I, they're running a small business with, with employees, and sometimes even without employees, and we're just trying to make the best, and create wealth for our family and our loved ones, right? And so that's exactly what we created, is that platform that we bring similar services to what a family office would have, but without the costs and the fees that, those individuals pay.
I agree. So we have Jamie asking a question. She has been very active throughout the presentation. She's asking you if the 50-50, that the slide that you share, is that a common percentage of investment, or is it different from your experience?
Yeah, so 50-50 refers into a model that we do tax diversification through, because we want to have control of how much taxes someone would pay. So, and it really depends on the individual, because if you're, for example, right now in a lower tax bracket, right? So, it might be worthwhile for you to maybe not take deductions today and defer everything for the future, get the compound interest, and then get everything in the future tax free or tax advantage. And vice versa. If you're in a higher tax bracket, maybe it's the opposite is true for you. So we look at what your tax brackets are along with your CPAs or accountant, and we kind of see, are you closer to a higher tax bracket or a lower tax bracket? And sometimes within $1 we get you reduced into the lower tax bracket, for example, right? And then that creates a different types of tax planning for you and for your business and for your investment. So it's not necessarily referring to the allocations of investments, right? We kind of look at, the allocation differently. It's based on risk tolerance. But on the tax diversification, sometimes it's 50-50, sometimes it's 60-40, 70-30, depending on what your tax situation now and what it's going to look like in the future as well. Because I mentioned briefly that, for example, most people don't realize they're going to lose the majority of the tax deductions as they get older. Think about it. Right now, you have a business, you have a home that you bought, and you're paying interest, and you're paying on the loan, and you're married, and you're finding jointly, and you have kids maybe, and you're having dependents. But what happens when we're like in our 50s and 60s? Kids are grown, we lost those deductions. Business, maybe we sold it or
Mm-hmm.
we exited out of it, and now we get income, we have no offset. The real
Exactly.
estate or the property that we bought now is fully principal, or it's free and clear. We lost all of those deductions. Some people lose a loved one, and now they're single filing, individually instead of married filing jointly. That's a loss of deduction. So we have to think about those things. And again, most people don't. And that's the awareness, right, that we bring to the table, that is more valuable than trying to make just one extra percentage a year and losing the big picture 30-40% every year for the rest of people's life. That tax efficiency is a tremendous value. And I'm glad that the question was brought up.
And she's thanking you, and she said a great presentation from Jamie. Jamie, if you want to have one-on-one consultation with RTV advisors, feel free to contact Adam.
Thank you, Jane.
There were a couple of slides that, because I'm very visual, that I was like, man, this is on point. The first one was like the passive money versus the smart money slide that you share. I
Yeah.
think from for our audience, and if you are just catching up right now, go back to the presentation and pay attention to that explanation that Adam gave right there, because we usually tend to think about passive money most of the times. At least most of our strategies are always focused on passive money, but the smart money strategic approach is how you play the wealth game, right, Adam?
Yes. Yeah, that's why it is a game. It's money and fiat currency. It's a value exchange, right? So, the more value we can keep in our pocket and in our family pocket, in our business, the more value we can create, the more we'll be rewarded in the future. And what I showed on that slide it's just on the tip of the iceberg.
Mm-hmm.
We have actual real practical strategies that people, that are maybe using just the traditional or passive strategies, that what we help them do with the smart strategies, and we bring a lot of value to the table in that way as well.
And I really love when you said that we need to create plans that benefit ourselves, but that doesn't mean that we're gonna be like not paying taxes or not contributing our fair share to the IRS. It's just like protecting our hard-earned money and making sure that we have or that we have the ability to create wealth that is going to transfer through generations, because
Yes.
people that understand the wealth game, that's what they do. They transfer wealth through generations, and the generation, like for example my kids, are going to be in a better financial position than when I started. And the idea is that they can keep transferring the hard work that we do through our lifetime to the younger generations. And I think that that approach, it's amazing. And when we talk about everything that Adam shared today, is we need to keep that in mind. We and Adam, like we do everything for our loved ones, and this hard work that we're doing right now, there is no reason for it to disappear in like 80 years. We have to
Yeah.
keep passing it through.
Yes.
um
We don't learn about money in school, in a way that is really practical and pragmatic and very related to people's lives, that we can actually walk away from school and utilize it in our own life, right? We
mhm.
maybe even when we learn economy, it's theory, a lot of it, and most people don't use it after school. And one of the things that I was committed to in writing my book, Unleash Your Financial Powerhouse, was to really give people the not only the big picture, but really showing them what the most successful people do for their finances, and empower you, the individual, to really create tremendous wealth and perpetuate it not only for yourself but for the kids, for the next generation. Because if we don't, even if you created the wealth and extraordinary wealth, so we see that a lot of people lose it in one generation. All this wealth gets lost, right?
Mhm.
And so financial education and literacy and financial dignity, what I call financial dignity, is extremely important. And that's what we're committed to at RTB Advisors.
No, it's perfect. Like, I don't know if you want to highlight very briefly again, because you mentioned that RTV is a one-stop shop. Do you mind just giving us another like elevator pitch for the people that just joined us, or the ones that usually watch like the last part of the show?
Yeah. Yeah, sure. RTB stands for Raise the Bar. That's what RTB stands for. Raise the bar. We believe in taking it to the next level again and again and again in every position, every situation that we are. And we are in. I'll encapsulate it in this statement. What we do is minimize taxes, risks, and liabilities, and maximize financial opportunities like savings, returns, and passive income and cash flow. And so, in every situation that we get introduced to or that we get referred to, or that we bring to the table, we assess those elements. We assess the 5 key areas. What are the risks that are involved in the foundational level? Is this entity or business or family protected? Do they have an asset protection strategy? Do they have a real growth plan, like a financial plan or a business plan that is really helping them take it to the next level and raise the bar, right? And is there any inefficiencies there? Even if they have structures right now, what are the inefficiencies there? Are they diversified enough? Not diversified enough? Are they making only 5% where they can make 7, 8, 9% in the same risk level, right? Or better risk level, lower risk level sometimes. And then after the growth, we look at the passive income strategies and lifetime income strategies, right? Unlocking those values. And then we look at the structures like healthcare. We look at transitional structures now to unlock those values, as we mentioned. And then it's the legacy and succession. And so, and the wishes of the business owner and the entrepreneur is what drives the recommendation and what we do and the introductions that we bring to other professionals. It's not that we drive an agenda. We're trying to understand what the entrepreneur wants and what they're doing, and what is the shortest way and the most optimal way and the most compliant way, because that's important too, to really help them get to where they want to be.
Perfect. I know that we are in the hour right now, and it's Friday, and you probably have the margaritas in the freezer. I mean,
Oh
in the
yes.
fridge. But
Yes.
before we go, Adam, I want to share with our audience your book, Unleash Your Financial Powerhouse, is available on Amazon. This is the book that Adam was referring to a few minutes ago. Make sure that you buy it, read it, and contact Adam so you can have that private consultation, because just like he mentioned a little while ago, it's extremely important that you have that one-on-one to address your specific needs. And that's it. Anything else that you want to add, Adam, before we go?
Yeah, I mean, if you buy the book and you're in the states that we're in, I'd love to sign a copy for you and dedicate it for you as well. And I'm hoping to hear feedback and see what you found valuable. This is, the writing a book is a long process, and I've been very, very blessed to learn what I learned, and was a commitment for me. That's my legacy. Part of my legacy is to leave and empower other people financially.
We have our friend Gino Reyes from North Carolina saying he's buying your book. He's gonna reach out to you too. Gino, saludos. I hope you're doing well, brother.
Thank you very
Um,
much.
so
Thank you.
thank you everyone for watching this presentation live. Adam, thank you so much for your time.
Thank you.
I really appreciate it, and I really look forward to working with you guys. And as you were giving your presentation, before we go, I want to share with you this maybe like a tagline for our upcoming series. Let me know what you think, Adam. A Smart Money series to learn how to play the wealth game.
I love it. I love it.
Sponsored by
Yes.
RTV Advisors and brought to you by the the U.S. Business Association of E-commerce and the Hispanic Chamber of E-commerce.
I love it.
It's
I
gonna
love
be
it. Have an amazing weekend.
it's
Thank you
gonna be
so much
great.
for having me on.
Thank you, Adam. Have a nice weekend.
Have a nice weekend.
Bye bye.